When the average person talks about investing, they tend to be talking about one of two things. Either they are referring to the stock market or the real estate market. Both of these markets offer a chance of profits for those investors that are willing to take the risk. How are these markets different? Which market is riskier, or which one offers higher profits? These are all questions that investors have to think about before making their initial investments. Hello viewers. Stephen here, and I welcome you to this channel where we talk about investing, business and finance. In today's video, we will be talking about the difference between the stock market and the real estate market. But before we begin, be sure you have subscribed to this channel and smash that like button on this video to support the channel. Thanks for doing that. Now let's begin. So, what are the significant differences between investing in the stock market and the real estate market? By investing in the stock market, an investor is purchasing intangible ownership in a company, whereas investment in the real estate market will yield a piece of physical property. Both markets will generate an asset once an investment is made. The assets in question are very different from each other. Is it more challenging to invest in the stock market or the real estate market? Depending on the country in question, where the market is located can determine the difficulty in actual investment. For example, only Chinese citizens and corporations that meet a particular condition can invest in the Shanghai stock market. Or how Mexican law forbids real estate sales within a designated area to non-Mexican citizens. How do investors make money in the stock market? Buying low and selling high, the stock market investor's mantra. The most basic way to make money on the stock market is to buy low and then sell the stock high. While this concept sounds simple, it tends to be far more difficult for new investors, though this does get more complex when investors look into the more advanced trading options. Let's say you are an investor that has to conquer the regular stock market and are looking for something with more significant risks but also greater rewards. Then you would start using the trading options of puts and calls. When an investor uses a put, they are shorting a stock. An investor uses the put option when they believe that a stock is overpriced and that within a certain amount of time, the stock will fall in price. So how does an investor make money with a put? Well, an investor is actually borrowing a stock from their broker, selling it at the current price, and they will then repurchase the stock at a later date at the market price. This means that if the stock dropped in value, the investor gets to keep the difference between the original price and the new price. But if the stock has gained value, then the investor will have to cover the difference. What if you believe that a stock is undervalued? Well then, as an investor, you would be using the call option. What then happens is that you make a contract with your broker to purchase a stock at the current market price after a while. If that stock then gains value, the investor can buy it at a lower cost. But if the stock loses value, then the investor will have to purchase it at a higher value. How do investors find a steady stream of income? While the majority of investors are looking for a stock to sell once they reach a specific price, there is a group of investors that look for stocks to hold on to. These are the high dividend stocks. Now, why would an investor want to tie up capital for a quarterly check? Imagine that you have an amount of money that you do not wish to manage actively. There are two options for that money. One is to save the money at the bank, where the bank will pay you a certain percentage of interest per month. Or you could purchase a stock that is known for issuing quarterly dividends. Some investors find that the quarterly dividend check far outweighs the monthly interest that they would have got from the bank. What are some of the positives of investing in the stock market? The biggest positive for any investor when they choose the stock market is the short-term nature of the stock market. This means that an investment can be profitable within an hour of the initial investment. When compared to the real estate market, the stock market is as quick as lightning. What are some of the negatives that an investor faces when they invest in the stock market? This is due to the fact an investor can see the trends the market is going and react before the worst happens. But if an investor is either using a put or call, that is an issue, as both of these options are like shooting an arrow. Once the drawstring is released, there is no going back. So, if the worst happens when using advanced trading options, there is no way to salvage the situation. The stock market is very volatile, and one wrong move can cost you everything. If an investor limits themselves to only the most essential buying and selling, they are less likely to lose everything. How do you make money from real estate? Well, the real estate market is very much like the stock market, with most of the profit coming from buying low and selling high. There is also a long-term option for making money, where the investor rents out the property to produce monthly income. There are several different types of real estate investments, with each offering their unique risks and rewards. In recent years, one of the most popular forms of real estate investing has become the flip or real estate arbitrage, where an investor will buy the worst house on a good street, renovate the home, and then sell it for a profit. This occurs with undeveloped land. If an investor finds a parcel of land that they believe will be worth more if sold to the correct buyer, investors always have the option of not selling their newly renovated property. If the investors want to make a steady stream of income, then there is the possibility that they rent out the property. There are two kinds of rental properties. General rental property is looking for long-term renters that will create a steady stream of income for the landlord. One of the most popular types of general rental properties is the apartment complex, where the investor can rent out many different units of an apartment complex. Then there are holiday properties that are located in areas that are popular with vacations. This kind of rental property can be further divided into non-seasonal and seasonal properties. Non-seasonal properties are located in areas that are continually seeing tourists. These tend to be located near the equator as they offer tourists something year-round, for example, the desert town of Palm Springs. Seasonal properties will sit empty for most of the year, but during their busy season, they will make up for that in a quick profit. These properties will be located in an area that is only popular during a specific time of year. For example, many houses in Florida fall under this category as Florida has seasons that tourists do not want to be there for their vacation. What if an investor does not want to deal with residential but wants to own commercial properties? If an investor wants to work with commercial real estate, they are generally not going to be doing that much different than if they are investing in real estate arbitrage or rental properties. The most significant difference has to do with capital requirements. It must be noted that rental property for commercial purposes can be very risky. An investor never knows if their renter's business will survive, and if that business goes under, if they will be able to find another renter. So, what are some of the positive aspects of investing in the real estate market? The real estate market is far more stable when compared to the stock market. There is also the possibility to earn a more substantial return on investment in a single sale. By selling a property, a real estate investor is more likely to make a more significant profit margin based upon a single transaction than an investor on the stock market. What are some of the negative aspects of investing in the real estate market? Earning money can take both time and work. There is a lot of work involved with not only renovating properties but also with marketing the properties. Both of these statements are true with residential and commercial properties. As a landlord, the investor will be taking on a lot of responsibilities that have to do with maintaining properties. In the case of real estate arbitrage, this responsibility will end with the sale, but for the investors that have found tenants or renters, then the responsibility has only begun. Which is riskier, the real estate market or the stock market? The question of which market is more dangerous is hard to answer because of all of the caveats that would have to be listed. When deciding which market is riskier, it is best to look at the worst-case scenarios. Let's say that you have access to a significant amount of capital, and you decided to purchase a turnover property that you plan to sell within a month. But if the economy takes a dip before you sell the property, there is the possibility that your property is now worth less than what you paid for it. The property is still worth something, just not what you paid for it. Inversely, let's say that you used that capital to purchase a single stock. Now, if that company goes bankrupt before you sell your stock, it will quickly lose its value before it is entirely worthless. The volatile of the stock market can sometimes appear like a giant roll of the dice. It's this volatile, as well as the possibility for an investor's entire investment to become worthless, which means that the stock market is riskier. Both markets contain risk. The stock market has more risk as it is more likely for stock to lose all value when compared to physical property. Is the stock market or the real estate market more profitable? One of the major misconceptions of investing in the stock market is that the quality of stock determines the value. When it comes to sharing, it's not quality, to a certain extent, but quantity. Stockbrokers make money when stocks go up, but by how much? That is the key. Imagine what is more likely: a stock that raises by $1 or by $100. It is more likely that a stock will gain $1, but let's say that an investor owns 100 shares of that stock. So, when it goes up by $1, that investor has made $100 profit once they sell their shares. On the other hand, when investors are looking at investment properties, they tend to think in the $100,000 profit range, or maybe if it is a rental property, a $1,000 plus a month. What we see with both of these situations is that the real estate market is more profitable in the short term. When it comes to the long term, it is impossible to say which market is more lucrative, as there are just too many variables to account for. Ultimately, an investor has to decide what strategy or market they will focus on. To be successful in either of these markets requires specific mindsets. One demands that an investor is willing to bet an entire fortune on the toss of the dice. The other asks investors to think in the long term. If an investor is risk-prone, then the stock market is where they should focus on, while an investor that likes to plan should focus on the real estate market. Well folks, I hope you've enjoyed today's video. Subscribe to the channel if you are new, and give this video a thumbs up if you enjoyed it. With that said, have a great day, and I'll see you all in the next one.